So what I'm going to be talking about today is going to be the one simple trading strategy every trader ought to know. This is our company, Major League Trading, and presented by me, Eric Marcus. So quick risk disclaimer just before we jump into everything. There's always a substantial risk of loss in trading. Only risk capital should be used to trade. Past performance is not indicative of future results. You guys all know this. You're the only one that knows your current financial situation and knows what you can and cannot risk. So what I'm going to show you today is going to be typical trading misconceptions that I think are out there in the marketplace. A simple step-by-step strategy that requires no fancy footwork. It doesn't matter what trading platform you have, you can set up simply 4 charts and make this work. Also, easy to follow rules for this strategy that you can start using immediately. And I'm also going to make it even easier, and if you use thinkorswim, I'm going to share my grid with you so you don't even have to build this out. You're going to get exactly what I see on my screen on your screen. But real quickly, for the people that don't know anything about myself, my road to the market consisted of working as a journeyman electrician 6 days a week. Pulled a stretch for a little under 30 days, working 7 days a week, 12-hour days, 10 on Sundays at one point. Just was not cutting it for me. This was one of the job sites I worked on in the bottom left over here. This is a wastewater treatment plant. So you can imagine what that actually ended up smelling like and being a place to work in. Not the best place. But that's not what I wanted to do. So I focused, studied the market, developed my own strategy and indicator that helped me consistently make money and make my life easier. Next month, I'm going to be on a road trip. I live in the Washington, D.C. area. I'm going to be working my way all the way across to Washington, down the coast of Cali, Vegas, Arizona, all that, because July makes 5 years since I quit my job, July of 2011. And until last year when we started up MLT, I've been trading on my own for, I guess, 4 years from that point. So it's been a good road, but it hasn't always been easy, as I'm sure some of you know. And with that being said, I've more than likely been in the same place in my trading journey at some point that you're at right now. So, like to travel, there's a picture of me with the Batmobile down at the Parker Brothers shop in Florida, my wife and I in Nebraska. This was that lunch that Renee talked about with Warren Buffett, which was really, really cool. This is my trading setup. I still have the desk. I've changed the monitors around, simplified my life. I only use 2 screens now, so much, much better. So now that you know a little bit about me, typical trading misconceptions, right? You can never go broke taking a profit. I think it's probably one of the worst things as a trader you can put in your mind. And what I think it does is it trains you to take profits too soon, not hold your winners as long as you potentially could, or to targets, right? It can mean the difference between being a profitable trader and an unprofitable trader. That extra 5 points on S&Ps 3-4 times a month, whatever the number is. So I definitely disagree with that statement. Trading is easy or get-rich-quick scheme? Definitely not. There's tons of horror stories out there. People trying to turn it into a get-rich-quick scheme and end up going broke. So definitely nothing can be further from the truth on this one. And then there's always that holy grail search that some of you guys may be in right now. You're looking for the next like automated setup or the next thing that's going to, just boost your trading. You've had some wins, you've had some losses, you're back to even, and you're seeking out that, that one surefire strategy that's going to turn it into a get-rich-quick scheme for you. There is no such thing. Trade small, trade often. So in my mind, I disagree with this one as well, because it's basically like taking a handful of you know what and throwing it at the wall and just seeing what sticks and hoping that something out of that ends up turning into a profit. But we all know how that story ends, is that a lot of that ends up falling off the wall and on the floor. So I definitely disagree with that. I think well planned out, larger trades of better quality can yield a better return in the long run. And then the other thing is news matters. So I remember in the beginning, you know, I always turned on CNBC, whatever, watched Jim Cramer. Same thing that probably 90% of other people have done. And at the end of the day, I found that it does not matter whatsoever. So the strategy I'm going to show you, just called the Major League Trading Divergence, plays really well off of what Anthony was talking about previously. So these are the simple rules to it. So what you're going to be looking for is when one or more of the indices don't confirm the other's movement. And I use this on a simple 5-minute chart. I don't look at anything else when it comes to this, just a 5-minute chart of the indexes. You can take positions around this in stocks, options, futures, or binary options. A couple people mentioned NADEX earlier. So if the NASDAQ creates a divergence and you like to trade Apple or Amazon or whatever it is, feel free to throw on that position in correlation with it. This one's really important. Your entry is one tick above or below the signal bar, right? If you do a poll and 99% of traders around the market, the biggest thing they're going to have problems with is when do I get into a trade, right? So knowing and having a clear set that tells you when you should get into a trade can drastically improve the mental capacity that you have to use when trading. Take that thought out of it. And then your exit can be at support or resistance, an opposing divergence, a pivot trail, or if none of those end up happening, you can go ahead and get out at the end of the day. So what is a divergence? We got market A, market B here. Let's call these S&Ps and NASDAQ, right? 5-minute chart, we've got a nice run up. Both markets set a high. Market A starts to pull back, market B starts to pull back, right? Nothing out of the ordinary right now. Next up, we got market A, S&Ps getting new highs on the day, right? Take out those previous highs. But market B does not. This constitutes a divergence, right? Really, really simple. And vice versa for the downside, right? One market would be getting a new low and the other one would not. So what does this look like? Well, here's a chart from the end of April, and what I've got here, like I said, it's really simple, 5-minute charts. S&P's in the top left, NASDAQ in the top right. I got the Dow in the bottom right, and the Russell in the bottom left. You can use the SPY, the QQQ, the IWM, and the DIA as well. It doesn't make a difference. But what I want to point out here is right at this white line, you'll notice at about 11:45, the NASDAQ and the Dow have their little low markers, right? But if we fast forward here to a little bit after 2 o'clock, you'll notice the S&Ps make new lows by 1 tick, and the Russell makes new lows, right? So that constitutes a divergence. And in my mind, when I learned about this strategy and kind of developed it, is I'm looking for potential highs and lows on the day in a way that allows me to potentially know that and benefit from it, because I like to play the extremes. I don't like to wait for moving average crossovers or anything like that. I'm usually buying as the market is pulling back or falling into a price, and then vice versa. I'm usually selling as we rally. So a couple quick steps that you guys can write down for this. Step number 1 is going to be identify the high and low of the top 4 indices, right? Top 4 indices, S&Ps, NASDAQ, Russell, and Dow. So what you'll see here, we've got blue lines that mark the highs and lows of every single index on the day. Now what you'll notice is at about 1 o'clock, NASDAQ starts breaking down and continually getting new lows on the day. But at the same time, there is one divergence on this chart that I didn't mark out, and hopefully some of you guys already can pick up on what that divergence ended up being. And if you didn't, it's right here in the Russell. At about 11:45, you can see the Russell makes new highs on the day here and continues to make new highs. While the S&Ps are way under their highs, the Dow's way under its highs, and the NASDAQ is way under its highs. So step number 2, after you've identified those highs and lows, you want to wait for one market to break that high or low and any of the other markets to not do so. And so in this example, once again, we got S&Ps up here in top left. We've got our low set at 11 o'clock across the board in the indices. But you'll notice on the Russell at about 12 o'clock through 3:30, we're constantly making new lows after that. So really easy to see that there. Step number 3, and this is where I said take that thought process out of what you have to do during the day, is entry is going to be one tick above or below the signal bar. And what a signal bar is just the lowest low 5-minute bar or the highest high. So really easy to see here. We've got market pulling back, we get new lows, and this sets up a divergence, right? When this next bar, the very next bar, breaks through the high of this low bar, right? This is our signal bar. That constitutes an entry with stop losses beneath the lows. All right, so really simple, and vice versa for trades looking to take to the short side. So let's take a look at this and see if we can find an entry. So looking at here, this is going to be the SPYs, the Qs, the Dow, and the Russell, right? So it changes up. You can use the SPYs if you don't have S&P data or whatever. You'll notice right here at 120, the Russell is making new lows on the day. The rest of the market's all bottomed about 12 o'clock. All right, you can see back here. At this point in time, Russell makes new lows. With that being said, I like to play the stronger or weaker, depending on which way the market's going, from the divergence. So in this case, I would look at potentially playing one of the other 3 that didn't get new lows, which is going to be the S&Ps, NASDAQ, or the Dow. And all of those on the very next bar, including the Russell even, triggered you into a trade with a stop loss beneath the low. So that's how you get into the trade. One more example here. You'll notice at 11:40, the Russell breaks to new lows, right? We've got a low wick right here at 118.94, which is exactly where all the other markets ended up having their lows of the day, about the same time, right? We end up breaking the highs on the very next bar of this low bar. And from that point, the market continues to work its way to the upside. Right, so entries are easy. One tick above or below the signal bar. Now, just like with anything in life, there are rules. You know that you can't go jump in your car and drive 90 miles an hour down the interstate and not get a ticket, right? It's probably going to end up costing you money. It's the same thing in trading. If you don't have rules, something to go by, something to follow that keeps you in line, it's likely going to cost you money. So rule number one for me with this strategy is don't trade the first 15 minutes of the day. Market's moving around the first 15 minutes. You've got everything happening from the overnight, and maybe it's a gap or whatever, and it's just not worth it to trade that first 15 minutes with this strategy. Can I define again what a signal bar is? Absolutely. We'll define a signal bar on this chart right here for you, Scott. And what that is, actually I'm going to give you guys a quick quiz. I made it really simple, but can you guys show me or tell me where the divergence is on this particular chart? Nobody knows? It's right here at 1040. Exactly. Nice, Dan. Nice, Ziv. There we go. Q's make a new high right at 1040. You can see the high marker there. Dow does not, Russell does not, and the S&Ps do not. So really decent looking divergence right there. So to answer your question, Scott, this 1040 bar in the NASDAQ ends up being your signal bar, because that is the highest high bar on the chart. All right, really easy. So expounding upon that signal bar, right? Rule number two is important. Waiting for the bar break. And that was an alert just now that the S&Ps are getting new highs through Globex. So rule number two, wait for the bar break. So to further make that easier for you, Scott, this is the signal bar. The very bottom green candle. So the reason that signal bar and that rule is in place is to potentially keep you out of strong trends that show a divergence initially but don't end up following through as a divergence. So right here at 1 o'clock, you'll see in the NASDAQ, we get new lows. The Russell, the Dow, they hold their lows. So this is a divergence with the NASDAQ. It never triggers the signal bar on the very next bar. And ultimately ends up going lower. We do get a small rally from there, but the very next bar does not break it. Is the break traded on intrabar once it's one tick above with a buy stop loss order one tick above the signal bar high? Exactly. So you're not waiting for a bar close. You just need to see a bar break. How do you pick which of the other three to trade? So I mostly trade the S&Ps and the NASDAQ, so I will by default go to one of those. I don't pay for Russell data anymore on one of my main accounts as far as the futures go. So if I wanted to trade that, I would trade the IWM, but by default I go to S&Ps and NASDAQ. Now, here's another example why rule number two is important and waiting for that bar break. What you'll see here on this chart is that right at about 12:30, we've got S&Ps pushing into new highs. We've got NASDAQ pushing into new highs. The Dow is pushing into new highs. But guess what? The Russell doesn't get new highs. and it doesn't get a bar break under this low, which ends up keeping you out of this potential strong trend that takes off. So really important, just like in life, to follow the rules. If you want to bend them, sure, but I put them in place for a reason that I've learned. So break of signal bar on second candle isn't an entry. It needs to be a break on the bar right after the signal bar. So you have signal bar and then entry bar. If the entry bar doesn't trigger you in, it doesn't count. So in this case, this next bar right here at 1240 would have been an entry bar, but it doesn't trigger. Another example here with Russell getting new lows, S&Ps, NASDAQ, and Dow not doing so. So real simple stuff, right? Everybody should be understanding and getting this. Now, moving on, one more example to the short side, and then I'm going to pop quiz you guys again. So you'll notice right here at about 11:15, 11:20, NASDAQ is the only market to end up getting new highs right here. S&Ps do not get new highs, Russell does not get new highs, and the Dow does not get new highs. Ends up triggering, ultimately NASDAQ ends up getting new highs on the day. But these new highs get shot down because none of the other markets end up getting new highs as well. So you've got two divergences on the day right there. Now, on top of that, there is one other divergence on this chart which I did not point out, and I'm sure some of you have already picked up on it, and it is right here at the lows at about 10:10. What we get right here is the fact that the NASDAQ holds morning lows, Dow breaks morning lows, Russell breaks morning lows, and the S&P breaks morning lows. So even though this first divergence I showed you at the top would have stopped, you had an opportunity to pick up longs and capture a large portion of this move to the upside. Now, up until now, I've showed you how to find the divergences. I showed you how to get into the divergences and kind of pinpoint, what's going on there. Step number 4 is going to be figuring out how to exit, right? That's the $64,000 question, right? If you can figure that out, then you're ahead of the rest of the game. Too many people hold too long. Too many people don't take profits when they should. And we're humans. It's going to be the nature of the beast, right? So having a solid exit strategy is important. Now, like I said before, exits can be a support and resistance, an opposing divergence, pivot trail, or end of day. So this was the previous example I showed you guys, right, where S&Ps and Russell got new lows right at about 2 o'clock. NASDAQ and Dow did not. They all trigger an entry. S&P triggers an entry, Russell triggers an entry, Dow triggers an entry, and NASDAQ. So let's start at the first one. Exit can be at opposing, or exit can be at support or resistance, right? This looks like a pretty good resistance spot right here. We paused here, we stopped here one more time. So probably a good place to get out, right? So a decent little move from 2049s, 2056, 2057s. And opposing divergence. Well, maybe you get out because the Dow gets new highs. The Dow rallies from this divergence, gets new highs on the day when none of the other markets do not. Look at this candle. When it gets through those highs and sets a divergence. Just gets smacked. You can also trail out at a pivot, right, if it gives you the opportunity. So the way I like to trail pivots is on a 5-minute chart and pullbacks. So in this case, we've got our entry here in the S&Ps. We pull back, set a pivot, rally up, pull back, set a pivot, and you just continue to trail these pivots as we move up. And if it doesn't get taken out, you stay in the trade until one of the other exit strategies, or when it gets to the end of the day, and you can go ahead and just close out. So a couple quick questions here. So the signal bar doesn't change even if the market keeps trending. You don't make the next bar the new signal bar even if you don't get an entry. Yes, so it does become the new signal bar, correct. If we continue to get new highs and we're running in a direction, or new lows for that matter, and we're moving in that direction, the highest high or lowest low bar ends up being the signal bar. So Eric, on QQQ, there's a large bar, small bar, and then a green bar. Wait for that signal to go long. Not sure which, that might have been on a previous slide and I missed your question. Gotcha. So here's what to remember. Wait patiently for a divergence play to set up. Enter on the break of a 5-minute signal bar. Exit at support and resistance, pivot break, opposing divergence, or an end of day. The key to the strategy is going to be patience and consistency. And when I say consistency, that means following the rules of the trading strategy and let the strategy play out. So in a nutshell, that's one complete trading strategy. No, there are stops, Scott. The stops are under or above the signal bar. You have a 1-bar risk on each trade if it triggers. So I did this manually, looked at charts quite a bit, and kind of got tired of doing that, right? I wanted something that let me know what I needed to be paying attention to and when. So I had a proprietary indicator built with the divergence in mind and a little secret ingredient. What it looks to do is identify potential highs and lows for the day with a simple arrow. Same thing, clear-cut definable rules for entries and stop losses, even bigger basket of products to potentially trade if you want. And I've now been using this for about 3 years. And what I did was just have a simple red or green arrow placed on the chart automatically when there is that potential for a divergence. And I also set it up to have an audio alert so that I didn't have to be paying attention to the screen, or if I looked away for whatever reason, I could be notified. So these red and green arrows on the chart are the divergences that you see. All right, we've got, like I said, ignore the first 15 minutes of the day. That was rule number 1. We've got a divergence that triggers to the short side right here in the S&Ps. Come down, we set a new low, get a divergence, right? But it never triggers. But we get one more new low, and that triggers. Right at about 1970 in the S&Ps. We get a few more divergences throughout the day, one right here at 12 o'clock in the NASDAQ, another one at 1400, although it doesn't trigger. So what's that look like if you took one of those trades? So it gave a short and it gave a long. I was bullish on the day, so I did not take the short setup. Exactly, I'm gonna show you exactly that right now, Dennis. So on the left you'll see this is a real live account on NinjaTrader. I took the futures trade to the long side. One contract, $412.50. So a little over 8 points, one contract. I took SPY calls in addition to that. Like I said, I was bullish on this day, so I wanted a long setup. I scaled in with a little bigger size, and this goes into your option strategy. I traded the 197.5 calls. They were weeklies for whatever week I'm in. I trade the weeklies. And this worked out to a little over $1,600 in profits. So all in all on the day, from that one divergence, a little over $2,000 in profits. Now, you can do the same thing on the short side. Yeah, Dan. The gardeners are outside and putting mulch down and all that stuff, so she's a little on edge. But anyways, yeah, so you can do the same exact thing to the short side, right? So you'll notice here at about 1 o'clock, we get a divergence in the S&Ps. Everybody can see that red arrow at the top. NASDAQ does not get new highs. Russell does not get new highs. So I took a short position. You'll notice the S&Ps come down, do not get new lows, right? But the NASDAQ does. So we've got a potential for another divergence on the day, which in this case, I used as an exit strategy. So what I did, in this example, like I said, real live account again, I shorted S&P futures, one contract, worked out to $572.50. You can see I was about 2 points from the low when I covered this. So just shy of 12 points. And then I did this exact same trade in the SPY puts. This time it was the 201 puts. And I did them equal size. Worked out to $573 in profit. So just shy of 1,200 bucks in profit on the day from one signal alone. Trading essentially the smallest size that I can in S&P futures, which is one contract. So what I've done is put this divergence indicator together in a package. What you can do with it is trade your favorite product or instruments with a proven setup. Clearly defined trading rules to keep you from chasing. Pre-built trade grids in TOS. So if you do use TOS, you can load this exact chart right into your TOS. So just a 4-window. Take the guesswork out of trading and let the setups occur. And you also gain that 5 years of real-world experience from me that I've had with this indicator and strategy. So the indicator itself, $999. The course itself and learning what constitutes a better trade, right? Whether it's a 1v3 or a 2v2. Combo days where you have multiple divergences to the tops and bottom side is a $499 value. Every single one of the trades I showed you guys would have paid for this value on that single trade. And then the trade grids are a time saver, right? Figuring out and coming up with how you see the markets and what the charts look like to you and the easiest way to view them on a daily basis took me a long time of finagling with the charts. So the total value is $1,698. We've listed it at $249. MLTclass.com. So whether you do buy or you don't buy, that's up to you. But if you do, what I recommend you do next, and even for those of you that just learn the strategy and don't take the indicator option, load the divergence indicator on your own computer, review the introductory video series, memorize these trade setups I showed you guys today. Right? That's something that everyone can do. You can load up 4 5-minute charts of each indices on your own computer and start reviewing previous day's sessions right now. Market's still open. And you can prepare for the next trading day. So mltclass.com gets you all of those, like I mentioned. And if anybody has any questions, feel free to throw them in there. We got a little bit of time left, so I may pull in a live chart so you guys can see what the divergence setup ended up being from today, which right now has led to about a 20-point rally in the S&Ps. And I'm sitting long a pretty decent sized position, need a little bit more movement to kind of cash out on that. It's a proprietary indicator. You'll get a shared code that you can load into your Thinkorswim chart. It does only work on Thinkorswim. So live chart would be nice. Well, since you asked nicely, we'll go ahead and load this in here. So the indicator, like I said, works only on Thinkorswim. What kind of day would you not look for divergences? I look for divergences every single day. When we get runaway strong gaps, one direction or another, right? So if we come off, so potentially today, right? Today, we may end up closing the day as a reversal, right? We were down on the day, 2040s. Now we're going to be potentially 2062s. We're down 1 point on the day. Tomorrow, and I'm bullish from these levels. 2042 is my level in the S&Ps. I'm bullish from these levels. If we continue to rally tomorrow, that'd be a second day of rallying in my mind. So I'm probably not going to try and take divergence trades to the downside. I'm not likely going to short tomorrow. So to answer your question, that would be a day that I would not look at it. So the trade setup from today comes in right here at 1050. You'll notice right here at these new lows in the NASDAQ, we get a signal. So pull up the signal. Now, my level was 2042s. Let's see if we can get it pretty close. In the S&Ps. So that was a level I was looking to get long at today. We get new lows in the NASDAQ at 1050. Look at what the rest of the markets are doing at 1050. The Dow not getting new lows, right? Dow's lows are way down here. The Dow actually right here, and this triggered me into one trade, ends up holding its lows right here. You can see these lows are down here at 17,372, 374. We got a room right there. The Dow does not get new lows. Followed by subsequent new lows by, looks like 2 ticks in the NASDAQ. Triggers a signal, signal bar, ends up being taken out on the next bar, triggers you in the trade. If you're trading the NASDAQ, you're long NASDAQ at 57.75 with stops under 52.50s. So about a 5-point stop, which is $100 a contract in the NASDAQ, if that's what you're trading. So really decent move from those lows though, 57s all the way up to 4,400. So about a 40-point move. That's $800 per contract, or 8 times your risk. Why did the ES not trigger new sell arrows at 1220? It made new highs on the day. Let's take a look. Right here at 1220, S&Ps do not trigger a sell area. The Dow does, right? And this is where that little secret ingredient comes in that I mentioned is built into the indicator. So that is the reason why it didn't give signals at that point. And so far only given one short signal here as we popped at new highs through the open on the day, which led to the first pullback after the lows. How is it helpful on futures and on ZB 30-year bonds? On futures right here, I just showed you, on the indices as well. It does not work on bonds. It does work on notes, but that's not a product that I like to trade a lot, so it's not my main focus. But I mean, realistically, you can take the strategy that I taught you today, load up a 4-grid chart just like this, go back 20 days, and compare and see where the signals end up happening, right? Or divergences for that matter. So really, really simple stuff.